Mergers, acquisitions, and corporate restructuring. Common reasons for mergers and acquisitions. First one, synergetic benefits. Value of AB is greater than value of A plus value of B because of synergy. Economies of scale, reduction of cost, diversification. Merger between two unrelated companies would decrease the business risk and increases market value, consequent upon decreasing the discounting rate or required rate of return. Next, taxation. Losses of target company will be allowed to set off against profit of acquiring company. Next, organic growth, decrease in competition, increase in market power. These are the reasons for mergers and acquisitions. Next, objectives for which amalgamation may be resorted to. For horizontal growth, to increase market share, to decrease competition, to utilize unutilized capacity. Vertical combination, to economizing cost and eliminates avoidable taxes or duties. Diversification, to mobilize finance, to increase cash flows, to proceed with the project. Different types of mergers. First one, horizontal merger. Horizontal merger means merger between two companies in same business sector. Example, Tata Motors and Mahindra merger. Example. Next, vertical merger. Vertical merger means buying supplier. Conglomerate merger. That means merger between two irrelevant companies. Example, Tata Motors and Zomato merger. Example. Next, congeneric merger. Merger between two related companies. Example, Tata Motors and TVS. Last one, reverse merger. Acquisition of public company by private company to form a new public company. New public company. It is a reverse merger. Next, takeover strategies. From the point of view of acquirer company, first one, tender offer. Tender offer. It is a public open offer or invitation, usually announced in newspaper advertisement by a prospective acquirer to all stakeholders of a publicly traded company, that is target company, to tender their stock for sale at a specified price during a specified time, subject to the tendering of a minimum and maximum number of shares. In a tender offer, the bidder contacts shareholders directly. The directors of a company may or may not have endorsed the tender offer proposal. To induce the shareholders of the target company to sell, the acquirer's offer price usually includes a premium over current market price of the target company's shares. Cash or securities may be offered to the target company shareholders, although a tender offer in which the securities are offered as consideration is generally referred to as an exchange offer. Next, street sweep. In this, large number of target company shares are quickly purchased by the acquiring company before it makes an open offer. Next, bear hug. Acquirer threatens to make an open offer. Here, target company board agrees for settlement with the acquirer. Next, strategic alliance means offering partnership rather than buyout. Example, L&T and Mindtree deal. Next, brand power. Alliance with powerful brands to displace the target's brands and as a result, buy out the weak company. Next, anti-takeover strategies are how to counter takeover bids from the point of view of target company. First one, crown jewel defense. That means sell off entire or some of the company's most valuable assets to look less attractive. This is one of the defense mechanism. Second, poison pill. It is a tactic used by the acquirer company to look unattractive. Next, poison put. Here company issues bonds which are redeemed at higher rates. Next, green mail or goodbye kiss. That means repurchasing a block of shares at premium in return for an agreement called standstill agreement. In this agreement, it is stated that bidder will no longer be able to buy more shares for a particular period of time. It is nothing but offering incentive to acquirer for not pursuing takeover. Example, target company may buy back own shares from purchasing company at higher rate. Next, white knight. That means get acquired by a friendly company to retain control of the target company. Next, white square. Get acquired by company not interested in takeover to retain control of the target company. Next, golden parachutes. Offering hefty compensation to managers who are upper executives if they get ousted, that means removed due to takeover. Last, Pac-Man defense. Target company itself make a counter bid for the acquiring company and let the acquirer defend itself. This is Pac-Man defense. So there are 8 defense mechanisms from the point of view of target company. First one, Crown Jewel Defense. Next, Poison Pill, Poison Put, Green Mail or Goodbye Kiss, White Knight, White Square, Golden Parachutes, Pac-Man Defense. Explain takeover by reverse bid. Acquisition usually refers to a purchase of a smaller firm by a larger one. Sometimes, however, a smaller firm will acquire management control of a larger and or longer established company and retain the name of the latter for the post-acquisition combined entity. This is known as a reverse takeover. Another, another type of Another type of acquisition is reverse merger, a form of transaction that enables a private company to be publicly listed in a relatively short time frame. A reverse merger occurs when a privately held company, often one that has strong prospects and is eager to raise financing, buys a publicly listed shell company, usually one with no business and limited assets. Three test requirements for takeover by reverse bid. The assets of the transferor company are greater than the transferee company. Equity capital to be issued by the transferee company for acquisition should exceed its original share capital. There should be a change of control in transferee company. There should be a change of control in the transferee company by way of introduction of a minority holding or group of holders. What are the benefits of reverse merger? Easy access to capital markets, increase in visibility of the company in corporate world, tax benefits on carry forward losses acquired in case of public company, cheaper and easier route to become a public company. What is divestiture and what are the reasons for divestment or demerger? Divestiture means a company selling one of the portion of its divisions or undertakings to another company or creating an altogether separate company. There are various reasons for divestment or demerger. To pay attention on core area business, the divisions or business may not be sufficiently contributing to the revenues. The size of the firm may be too big to handle. The firm may be requiring cash urgently in view of other investment opportunities. Explain the reasons for selling the company or explain the sell side imperatives. Competitors' pressure is increasing. Sale of company seems to be inevitable because company is facing serious problems like no access to new technologies and developments, strong market entry barriers, geographical presence could not be enhanced, badly positioned on the supply and demand side, critical mass could not be realized, no efficient utilization of distribution capabilities, new strategic business units for future growth could not be developed, not enough capital to complete the project, window of opportunity, possibility to sell the business at an attractive price, focus on core competencies in the best interest of the shareholders. Where a large, well-known firm brings up the proposal, the target firm may be more than willing to give up. Explain different ways of demerger or divestment. Different ways of demerger or divestment. First one, sell off. It refers to selling a particular division, asset, product line, subsidiary, or factory to another entity for an agreed upon sum which may be payable either in cash or securities. Spin-off. It refers to the separation of a part of the existing business and creating a new entity. Shareholders of the existing company continue to be the shareholders of the new entity with the proportionate ownership. There is no inflow of cash as compared to sell-off strategy. The reason behind spin-off divestiture is the intention of the management to have specialization in a particular area. Split up. A corporate action in which a single company splits into two or more separately run companies. Shares of original company are exchanged for shares in the new companies with the exact distribution of shares depending upon each situation. This is an effective way to break up a company into several independent companies. After a split up, the original company ceases to exist. Next, equity carve-outs. This is like spin-offs. However, some shares of the new company are sold in the market by making a public offer. So this brings cash. More and more companies are using equity carve-outs to boost shareholders' value. A parent firm makes a subsidiary public through an initial public offering (IPO) of shares amounting to a partial sell-off. A newly publicly listed company is created, but the parent keeps a controlling stake in the newly traded subsidiary. A carve-out is a strategic avenue a parent firm may take when one of its subsidiaries is growing faster and carrying higher valuations than other businesses owned by the parent. A carve out generates cash because shares in the subsidiary are sold to the public, but the issue also unlocks the value of a subsidiary unit and enhances the parent's shareholders' value. The new legal entity of a carve-out has a separate board, but in most carve-outs, the parent retains some control over it. In these cases, some portion of the parent's firm's board of directors may be shared, since the parent has a controlling stake, meaning that both firms have common shareholders. The connection between the two is likely to be strong. That say, sometimes companies carve out a subsidiary not because it is doing well, but because it is a burden. Such an intentions won't lead to a successful result, especially if a carved out subsidiary is too loaded with debt or trouble, even when it was a part of the parent and lacks an established track record for the growing revenues and profits. Next, sale of division. In case of sale of division, the seller company is demerging its business, whereas the buyer company is acquiring a business. For the first time, the tax laws in India propose to recognize demergers. Next, write a short notes on financial restructuring. Financial restructuring is the reorganizing of a business assets and liabilities. Consequent upon losses, the share capital or net worth of the companies gets substantially eroded, sometimes leading to negative net worth, putting the firm on the verge of liquidation. To revive from this financial restructuring is resorted to. To reviving from this financial restructuring is resorted to. It requires the need to restart with a fresh balance sheet which is free from losses and fictitious assets. This causes sacrifice on the part of shareholders of the company. Sometimes creditors may also agree to reduce their claims and also convert the dues to the agreed extent in securities. Explain the reasons why mergers fails to achieve their objective. 7 reasons why mergers fails to achieve their objective. No common vision. Second, nasty surprises resulting from poor due diligence. Next, poor governance, poor communication, poor program management, lack of courage, weak leadership. Write a short notes on cross-border mergers and acquisitions. Cross-border mergers and acquisitions is a popular route for global growth and overseas expansion. Cross-border mergers and acquisitions is also playing an important role in global mergers and acquisitions. Other major factors that motivate multinational companies to engage in the cross-border mergers and acquisitions in Asia includes the following: globalization of production and distribution of products and services, integration of global economies, expansion of trade and investment relationships on international level. Many countries are reforming their economic and legal systems and providing generous investments and tax incentives to attract foreign investment. Privatization of state-owned enterprises and consolidation of the banking industry. These are the cross-border mergers and acquisitions data.